My name is Michael Duke, and this is the show where I analyze stocks that are interesting. So if you find that interesting, then please consider liking the video, subscribing to the channel so you see more. Today, we have a request by a viewer, personal friend of mine, Rocco. He he also was the one who requested the PayPal video that I did a few weeks ago. And he sent me a note a few days back. I'm a little behind. He sent me a note a few days ago where he said a little more contrarian than PayPal. So he sent me an intrinsic value calculator. This is really the premise. Things like asset impairments and goodwill impairments suppress earnings but still allow for cash. So I think what that means is that while the company might be facing challenges, seemingly we see that borne out in the stock price potentially, that the book value of the company, whether true or implied, is there's enough assets there to create a deep value opportunity. So that's what we're going to be evaluating. I really don't know anything more about the company than what him and I have discussed over text. He's given me kind of some of his thoughts, but I'm going to be a little bit different style today, kind of like the PayPal video. I've never analyzed the company before. I've never looked at the website or the products or anything like that. So I'm going to be doing that here right now. So let's get into it. So VF Corporation, ticker VFC, engages in the design, procurement, marketing, and distribution of branded lifestyle apparel, footwear, and accessories for men, women, and children. Three segments: outdoor, active, and work. So what are our brands? North Face, Timberland, Smart Wool, Icebreaker, and Ultra. I know North Face, I know Timberland. North Face being, of course, outdoor apparel, Timberland being those pretty nice, fancy boots. A lot of cultural value in Timberland's. East Coast 90s hip hop fan here. Timberlands are a piece of that kind of underground culture, which is interesting. We also have Vans, Supreme, Kipling, Eastpak, and JanSport. In addition, the company provides work and work-inspired lifestyle and protective footwear under the Dickies and Timberland Pro brands. Interesting. I used to live in Fort Worth, Texas. That is where the Dickies headquarters was, at least at one point. They might have left. It was actually pretty close to where I used to live there. I would walk by it sometimes. First impression of all the brands here. There's some brands that I know. Of these brands, I know the Dickies, I know Vans and Supreme. So right off the bat, what do we know? We know that this is consumer discretionary. That's echoed here. Yeah, consumer discretionary. It's apparel. So a couple thoughts there. I have a bias against discretionary things, discretionary stocks. I don't like them typically. So that bias might cloud my judgment. Just take what I say with a grain of salt. And then the further layer of that is that I especially do not like consumer discretionary right now. The tariffs, the tariff situation is troubling. So I think in order there's the whole kind of thing that Rocco wanted to take a look at, which is again what I believe to be an analysis of the balance sheet. Is there value there versus what it's trading at? So we're gonna attempt to do that the best way we can. But right off the bat, I think what we're looking at is not only a business that has faced roughly a 20% decline in sales from kind of COVID-induced highs here. We're going to have to go back further to get an idea. But basically, revenue is where it was in 2020, roughly. And we do know that there's been a lot of input inflation over that time. So right off the bat, I can tell where the challenges are. Because some of these brands are, notable, there is realistically some modest pricing power there. But again, it being discretionary, that's challenging. What I was going to say about the tariffs is, again, what my brain is telling me intuitively is that a majority, if not all, of these goods are likely manufactured overseas, probably in Southeast Asia, Vietnam, Thailand, something like that. So we're going to attempt to figure that piece out too. So right off the bat, that is a concern for me when evaluating this. Because if we do find that the book value, or really what I mean by the book value is the intrinsic value. If we find that the intrinsic value of all the assets and stuff are substantially more than what is trading at, we're still backstopped by a very challenged market segment right now with an uncertain outlook. Now, of course, Berkshire Hathaway, it's the classic example of, a dying, challenged, and, just dead in the water business that Warren Buffett purchased. He was forced to purchase it, by the way. That's a story for another. He forced himself to purchase it. He had doubts about what he was doing there, would be my suspicion. But the value that was created as a result of that was that there was enough control that he was able to attain over that entity, that he was able to reallocate those resources himself. If I go out and I buy even $100,000 or dollars worth or $1 million worth of this stock, I'm not going to be the controlling shareholder. And therefore, it's a little bit more challenging. We see market cap of $4 billion. So anyways, let's look at the brands. We already discussed that. These are our big brands here that we all recognize. Ultra, I think is a kind of up and coming brand. Yeah, founded 2009. I'm pretty sure my wife swears by these shoes, and they're her favorite type of shoes. So that's, gets a plus for that. JanSport, we've heard of that. These other brands, though, I'm not admittedly familiar with, which is fine. But let's just take a look at the investor presentation. March 6, 2025. Never looked at this before. Today is about our brands. Okay, so they're going to seemingly highlight and emphasize the power of their brands versus, the other elements here. We will return to growth through, the beta of the market, the apparel market, market share gains. That's important, and category expansion. Okay, so their goal to reduce costs and strengthen the balance sheet, on track to deliver initial $300 million in cost savings, actions underway to generate an additional 2x from there. Changed the operating model, created America's regional platform, re-engineering entire organizational structure for effectiveness and efficiency. And then we have some leadership changes. We're building a new VF that is positioning brands, blah, blah, blah. Gross margin expansion is how they're going to get 250 to 300 million. And then they're going to reduce their sales and admin expenses, distribution and logistics. Okay, so right off the bat, again, if we remember, this is March 6th. That's less than a month prior to the Liberation Day announcement. So right off the bat, when we're talking about margins and costs being cut, both of those things are severely thrown into doubt in my mind without looking at the numbers. Again, we're going to do that without looking at the numbers. That the having massive tariffs on countries, we're not having tariffs period on the country where these products are originating from, where they're being manufactured, that places downward pressure on those numbers, right? It has to, because our tariffs are cost of goods sold. If we're selling them in America, but we're building them in Vietnam, that's cost of goods sold. That is a headwind to gross margins. Not necessarily SG&A, but our logistics costs, again, they have logistics maybe in their SG&A, which is a little puzzling to me. I would think that would be cost of goods sold, but I'm not an accountant. That's why this is why I'm not an accountant. But either way, I would think that logistics costs also would be impacted by that. But maybe that comes down to how they bucket them on the income statement. There's a lot of things that they seemingly voiced over on the call that I'm obviously not listening to now, that might give some additional context to these. So please understand that. We have significant potential to grow Timberland. I agree with that. Here again, you see wearing custom Timberland boxing boots. Again, there's Timberland does have cultural relevancy. They did discuss here cultural relevancy. Wow, I see. I didn't even put two and two together there. I do understand the cultural significance of that brand. It's a strong brand. As far as apparel companies go, I do like some of the brands, at least the ones that I recognize. Here is some stuff that I don't know is very material to what we're trying to find here. They're saying, yeah, brand innovation, collaboration with the Skims. That's their marketing and sales output. Okay, well, I'm not gonna exit out of this. I'll come back to this potentially. Dickies. We're talking about the Ultra shoes. Okay. So look, here's the deal. I would say that another company I covered, the only other company I've covered in apparel and discretionary, was Nike. I gave that one a very, very negative review. Nike has strong brands. I would say that these are pretty strong brands too. That did not save my analysis. And the kicker there is because despite a struggling environment, I did believe that the valuation of Nike was not conducive to outsized returns. This, I would assume that the valuation here is substantially lower than that. But what I want to look at, let's look at the earnings presentation. So we're actually in Q3 of fiscal 2025. Quarter ended December 28th. We should expect to see earnings. Okay, so they release earnings about a month. Well, did they push out their earnings report? Because see how this is 4 months after here? What's going on there? I would expect earnings in 2 weeks or less. That's a little puzzling, but either way, this is the earnings report for the quarter ended right before the year. Again, what we're operating with here is information that I believe is materially different in terms of their guidance, materially different than what it probably will be. Right off the bat, it's important, I would expect their guidance to be significantly shifted in light of the tariff uncertainty. that being said, let's take a look at their earnings. Again, I don't think that this is in line with what Rocco was wanting to look at, but I think that this is very, very important. So in the quarter, revenue up 2%. So that's good. So I believe that it's because of market share losses. It's seemingly, they say here, global strength at the North Face and Timberland. That's seemingly a market share gain. They did discuss that in the Investor Day deck. Operating income and adjusted operating income, 226 and 324 million respectively. Operating margin up 1,100 basis points. That's pretty good. And then adjusted operating margin up 360 basis points. Gross margins expanded and year-to-date cost savings. So in the third quarter of 2024 fiscal year, they had negative earnings per share, and now we're showing a profit, and debt is down a lot, which is good, and inventories are down. So that looks good. Here's where we get interesting. So they're establishing the forward guidance. Again, this is the quarter that would have ended 3 weeks ago. They said that they expect revenue to be down mid-single digits versus the prior year. This is something to do with constant currency, I believe. They're saying that they're expecting to take a small loss, an adjusted loss, but they are increasing free cash flow to 440 million. Now, this is important, right? So again, let's just assume that they have all this manufacturing in Vietnam. Again, I keep coming back to Vietnam. Perhaps I'm making an assumption. I am making an assumption, but I'm just using it as an example. Let's say that they have all these factories in Vietnam, and the current tariff rate, I believe, of Vietnam is 10%, right? Because the leadership of Vietnam reached out to Trump. They talked. He, put the 90-day freeze, and now we've got the 10% blanket tariffs. Let's just say that the Mad King, President Trump, Vietnam does something that doesn't like or whatever, and he feels like he can squeeze China, whatever. A lot of that goes over my head, but let's just say that he decides that Vietnam tariffs are 50%. Well, and all of the manufacturing is located there, and they need to manufacture it elsewhere in a nation that doesn't have big tariffs. That's capital expenditure, right? And that decreases free cash flow. So they're expecting to free cash flow 440 million. This is prior to our tariff announcements. So I would say, again, I'm flying in blind here. I would say that the free cash flow outlook is probably up in the air, hard to pin down. Okay. Again, I'm coming into this blind and learning as we go, but I would be highly skeptical. I am highly skeptical of this. However, if this is achievable, if they hit that, then that would imply that at the current market cap, we are at a 10% ish, more than 10%, 11% free cash flow yield on a forward basis. Okay, so that's pretty good. Brand spotlights. North Face was up, Vans struggling, Timberland up, Dickies struggling. Here we have, sales in Americas are up, EMEA, APAC. So, okay. Asia being the strongest market. Direct to consumer is down, but wholesale looking good. This looks good here. Significant reduction in debt. They paid down a $1 billion term loan. They did pay the dividends. That's good. And this is where we're kind of getting into the core of what we're trying to just discover here is the balance sheet um, getting into a good place. Because let's just assume for a second that we have a company like this that has all of the macroeconomic uh, headwinds that it's facing. But in theory, if a company like this had zero debt and billions of dollars of cash, and that cash was more than what they were trading for, that would be interesting, right? Do they have a balance sheet? Again, here's our guidance. Here's our revenue numbers. I don't. So let's take a look at this. Let's look at this right here. This is getting interesting. Okay, this is getting really interesting. So, December 2024, remember, is our most recent quarter. 1.3 billion of cash, 1.3 billion of AR, and 1.8 of inventories, 514 of other current assets. So we have $5 billion of current assets. Okay, that's more than our balance sheet or our market cap, excuse me. Goodwill and intangible assets, write those off. We got to subtract those. 718 million of property and plant and equipment. 1.2 of other assets, not sure what those are. But 10.5 billion of assets minus our goodwill is, 8.2 billion. 8.2 billion minus our current liabilities of 3.2. So that is, essentially 5 billion of room to work with versus 5 billion, and then we still have 3.8 of long-term debt. Balance sheet looks pretty decent, I would say. The balance sheet looks pretty decent. What I would like to see, I believe the 10Q might be what I want. That is not much more granular than what we saw in the last slide. So our market cap is 4 billion. Our long-term debt, that's a real liability. We have essentially 10.5 of assets. We have more goodwill here than equity. When we strip out the goodwill, that would imply that we have negative equity. This is monkey brain thinking. That doesn't look good. A bunch of cash in excess of everything else, including lots of property, lots of cash. And I'm really struggling to articulate my thought here, but I don't believe that this looks particularly appetizing. Maybe what we should do is take a look at how our Seeking Alpha is valuing the book. They say it's 2 times book value. Less than 1 times price sales is good. Less than 10 times cash flow, good multiple. They're saying price earnings growth, less than 1 on a forward basis. That looks good. However, I'm very skeptical about earnings now. So here we're saying that we're trading on 2 times book value. So how they're calculating that is last close price divided by the next fiscal year consensus book value per share estimate. That's forward looking. I think we need to look at this. Last close price divided by the book value per share. Book value is the firm's assets minus its liabilities divided by the total number of shares. Assets minus liabilities. In other words, the amount of equity divided by the market cap, or the market cap divided by the equity, rather. And Rocco, if you're watching this, forgive me if I'm misunderstanding the purpose here of the intrinsic value calculation. Again, this is pretty quick and dirty here too. I'm not really diving in deep, but right off the bat, I would say, maybe we need to take a look at what you said. asset impairments, particularly intangibles, and goodwill impairments suppress traditional metrics, but still allow, I think, where we have intangibles, right, that are somewhat muting this. But without diving in too deep to the numbers, for a company to be this kind of Buffett-esque deep value, we're buying a bunch of cash that we can reallocate. I think a bare minimum requirement is for that company to trade at a book value less than one. In fact, significantly less than one, like below half. I've made a couple of very, very small bets over the last few years where, something's been far below book value. Again, we know book value is book value is one metric, and depending on what the company is, can be drastically different in its actual meaning. But there was a company in the Permian. Oil was low. It traded way below book value 2020. That was attractive to me. I did good on that. The company I covered last week, Jackson Financial, is another example. That one's still trading at half book value. So right off the bat, I think if we're talking about a deep value opportunity, it's got to be trading meaningfully below book value. If I understand the premise here, the premise is that there's actually, if I understand correctly, there might be more goodwill, in fact, or more intangible assets than what we're seeing here. I really kind of take the opposite approach, and I don't like to factor in goodwill and intangible assets, period. And so if I subtract that out of my equity amount, then in my mind, that means that we have negative equity and we have negative book value in that regard. So I'm thinking if we have something that's trading at a 0.0001 book value versus something that trades at a negative, like a negative price book because the equity is negative, does that mean that it's a bigger opportunity if it's negative? This is where I'm starting to get somewhat outside of my circle of competence, I believe, because these price book is a good metric for this type of opportunity. I believe that it is the metric. But I gotta say, the balance sheet looks pretty good. It looks good from the standpoint of 5 billion of current assets. 5 billion of current assets versus 3.2 billion of current liabilities. That looks good. And if they wanted to exhaust half the cash they have, again, only half the cash, they could relinquish the entirety of the current portion of the long-term debt. If you combine all of the AR and the cash, that's enough to meaningfully pay down all of this, and cash and AR, not quite enough to pay off current liabilities. The point is this: the balance sheet is strong enough. It's strong enough to make me feel like, as a potential investor, to feel like there is some margin of safety here. That being said, the dividend, which I think is a big piece here, we see here the system here is warning of a dividend cut. It has a pretty decent track record of that. But just looking at the valuation, we've traded down quite a bit. We only have a valuation grade of C+. Some of these metrics nudging up. If you assume that sales are going to continue and be strong, it's, I would say, a good valuation. However, I think our book value needs to be a lot, our price book ratio has to be a lot lower for the intrinsic value. Shares trading below book value type pitch to be accurate. So I got to admit what we're talking about here when we're talking about the asset impairments and goodwill impairments suppress traditional metrics, but still allow for cash to be returned to the investor. I'm really trying to reconcile that view with what I'm seeing here, and calculate on the top of my head if that makes sense to me. What we're saying there, oh, see, that's what we were already looking at, of course. When we're adjusting, where's the reconciliation? Good gross profit margin, by the way. Is there some sort of adjustment of our goodwill or anything like that? Okay, here we go. So in the 9 months, in other words, fiscal year 2025 so far, 9 months ended here. Okay, so we are writing down intangible assets. I believe in the context of an apparel company like this, what that translates to is a brand, a clothing brand, apparel brand has a certain brand value. We're carrying the value of that brand on our balance sheet. When that brand is struggling, shrinking sales, losing market share, or whatever, then we may feel the need, or we may be required to, under GAAP, to actually impair that asset or, write off, take a loss on that asset. You see kind of the smoke and mirrors involved in that. In other words, we're saying we're actually reducing our profits in income from continuing operations before income taxes. We're reducing our profits by 51 million, which is like 20% of that eventual bottom line number, or 7% of the total segment profit. So I think what I'm understanding here is this is a non-cash expense, right? Whereas these are cash expenses, corporate and other expenses, interest expense. They might not all be they might not all be cash, but this is definitely a cash expense, and may be reasonable to assume that a lot of these are cash. There's not really granularity to these numbers. We do see that they have been impairing the goodwill and intangible assets all the way back into the prior years. I don't really understand why they're doing that, so I'm not going to attempt to reconcile that. We see here that this is in terms of the reconciliation of cash flows to the balance sheet, we do see that they're adding those and showing you the difference between cash and non-cash. If the idea here is that we're reducing our goodwill by taking an impairment quarter after quarter after quarter, or what have you, that will, if this number goes down, then so does this number, right? But it does. I'm already reducing that to zero. I'm basically, in my mind, I'm impairing that all the way to zero just for the ease of mental calculation. In which case, again, we've got more goodwill than equity. So through that lens, is it not safe to say that the balance sheet and the entirety of the market cap is essentially goodwill plus another 50%? Figured in the meantime, I would explore the exposure that the company has to tariff risks, because I think where we're at now, basically what I'm seeing is that the balance sheet is healthy enough, is what I see. The balance sheet is healthy enough, and nothing looks too prohibitive here. They have enough current assets to be able to navigate the challenges with their sales. But again, I want to reiterate, as has been a theme with this whole analysis, that the tariff risk introduced in the time since we've seen these reports and since management has given guidance on anything, I think that becomes the next box that we need to check. So what I did in the meantime while I was taking a break is I launched deep research to find and scrape the web to find as much information about where VF sources their production, whether it's in-house or outsourced, and where the raw materials come from. And so I'm just going to refer to that report as well as some of the sources that it highlights. So a majority of VF's manufacturing base is in Asia. Over 55% of the garment factories are located in Asia. China and Vietnam are the single largest country sources. China alone accounts for roughly 23% of VF's contracted factories, and Vietnam about 12%. Other important Asian sourcing countries include Bangladesh, Cambodia, Indonesia, India, and Turkey, among others. For instance, VF did reduce the number of factories in China, India, and Bangladesh between 2023 and 2024, 12 fewer factories in Bangladesh, while adding suppliers in Vietnam, Cambodia, and Indonesia. So one positive here is that the company does appear to have a fairly diversified footprint of manufacturing. About 21% of VF's garment factories are in the Western Hemisphere. Major sourcing countries in this region include Mexico, Brazil, Guatemala, Honduras, El Salvador, Nicaragua, and a smaller portion in the United States. Smaller portion of 21%. So I think it's worth noting that that might be 1-ish% in the United States. The remaining share of VF sourcing come from Europe, the Middle East, and Africa, or EMEA. Now, one thing that's different or interesting here is that the number of contracted apparel factories between Q1 and Q3, Q1 2023 and Q3 2024, which is what we were looking at. Or no, sorry, Q3 2025 is what we were looking at. It's unclear if this is actual quarters or fiscal quarters, but in the case that they are fiscal quarters, they are lower, or they're at least a year in the past. VF's own analysis indicates that Asia is indispensable not just for finished goods, but for materials. As of Q3 2024, about 83.5% of VF's textile raw material suppliers are in Asia, with China supplying nearly half of VF's fabrics, yarns, and trims. So another thing that this discusses is that the majority of the production, 94% of the units, are produced by independent contractors, whereas the other 6% are owned by the companies. Usually, all other things being equal, especially with something like this, the switching costs are going to be lower than something that you own. Where that's negative is if we tariff the entire world at an insanely prohibitive amount, and all of that needed to be, produced domestically, which again, that's not necessarily realistic, but just in theory, if that were the case, then it would require a significant amount of capital expenditure to build the capacity here, because I think it's reasonable to assume that there aren't that many. There isn't much of an ability to outsource that production domestically. But then we have the kicker of the materials, half coming from China. So here is the issue with that. Between the raw materials and the finished goods, we have significant China exposure. Okay. Now, we've basically declared economic war on China. And while a company like this, it's a ton of brain damage, okay, first off, for this company. The people in this that work in supply chain at this company are probably super stressed right now trying to figure this all out and get this done. They're trying to source, move production. Everything that's going on right now is accelerating the what they've already been doing. It's bringing the immediacy of the timeline into focus. Now they've been doing a good job of diversifying that away from China, but the raw material is problematic because let's say that I'm this company. I'm sourcing a lot of my production in China and Vietnam, just like they are. And because of the tariffs, it is now cost prohibitive to manufacture in China. So I've got to move all of that production somewhere else. And where I'm probably going to do it is the majority of it is going to end up in Vietnam. So now let's say, I've got 2 times as much production in China versus Vietnam. I move all of that production. We'll keep the math simple. I'll move all of that production to Vietnam. Now I've got a third of my production in Vietnam. Okay. They might not quite do it like that, but you get the idea. Let's say that all of our production has been taken out of China and we replace it with Vietnam. However, the factories in Vietnam are sourcing half of their fabrics, yarns, and trims from China. Okay. And China, again, we're in the middle of this large scale trade war, but they still need to buy materials from China. So what China does is it imposes a big tariff on Vietnam in retaliation for that, or to mitigate that from happening and keep supply chains more sticky. Can they source those materials elsewhere? And maybe they can, maybe they can't. I don't know. What I do know is that there is a lot of tariff risk going on here. We haven't looked too much at the like inertia of the earnings because I really don't think that it's super relevant to what we're doing here. I looked at the revenue numbers enough and the guidance and everything. I'm going to take that at face value, and I'm going to say that it doesn't look bad. And I also think that the balance sheet looks pretty good, but I would not say that it is deep value because again, we are not trading below book value, and furthermore, we're not trading anywhere near cash value, and that's what I would like to see. We're trading. Our market cap is less than cash, AR, and inventory. So obviously with our inventory, depending on how they categorize that and book that, let's just assume that all of the inventory that they have is not subject to tariff risk. Well, they may be able to get better pricing on that selling it because there's less supply of the new stuff subject to tariffs. So, okay. They have more current assets than their market cap. However, when you net out the debt and everything, ideally, I'd like to see current assets minus current liabilities be greater than market cap. To me, that would be a much stronger value proposition. And furthermore, if book value was below 1 and substantially below 1, that would be much more appetizing. I see how there's value here to be created, but I don't think that it's cheap enough. I don't think it's cheap enough. We've got a 3.5% dividend, which might be cut. If you're the management here, you would want to cut the dividend, and they have been cutting the dividend, and that's allowed them to shore up the ability to pay down this debt. So it's conceivable to think that they keep this dividend and just keep it flat, or they cut it further. Right? Think about if you're the manager of this company, you would want to pay no dividend. So you could figure all this out, right? And that might be what's best for the company. Me as an investor, I do want to be compensated in cash while I wait for something to re-rate. I really do. If I'm doing these types of plays, I want to be compensated in the form of cash, and not just cash, but at least a very, very strong level of cash flow until the cut occurs. As you can imagine, that makes the universe of things that are investable very, very small for me in this regard. So, again, we've got a C+ valuation grade here, which basically means like there's value there, but it's not strong. And I think that the valuation grade is dead on. It is a good valuation, but it's not a deep value play for me. And when we combine that with the fact that there is an enormous amount of exposure and risk to the tariff issue, I think that there's tons of volatility to come before this gets resolved. Because what ends up happening, let's just assume that all the tariffs that have been announced up to today stay permanent. If that were the case, then this company has a lot of work to do to source new areas of manufacturing. And furthermore, the new manufacturing sources need to source new inputs away from China potentially, or they need to diversify. So, are they able to switch to an option that's as cost effective? Maybe, maybe not. Probably not, right? So, what they're saying here about gross margins expanding, where was that? What they're saying about this, I don't buy that. I'm highly skeptical about that. And this I'm skeptical about, but to a lesser extent. So that is a big issue for me. Let's talk about the correlation of tariffs and tariff risk. Yesterday, I made a video about Prologis, and Prologis is crushing it today. Actually, they did break through the $100 level, which we had discussed. So that's actually super bullish. But I had downgraded it to a hold. The thing that I discussed about Prologis was it's now correlated to tariff news. And I want, right now at this point in time, I want to be deploying capital into investments that are non-correlated to tariff news or inversely correlated to tariff news. One thing we talked about how was when tariff news comes out, gold trades up. You see today, stocks are up and gold is down. But gold exposure and precious metals exposure has an inverse correlation, arguably, to tariff news, right? And so that makes it a compelling investment when you don't know on a day-to-day basis what tariff news is going to drop. This company has a demerit in the worst way possible, in that the underlying business is highly exposed. Arguably in the upper decile of all companies, this company has more exposure than average to these tariff issues. And that should mean that the stock price is highly correlated to tariffs. Okay. Now, what that means is if Trump gets on Truth Social tomorrow and he says something to the effect of all tariffs are canceled. Well, this stock might pop by 10% or something like that. So the sword cuts both ways, but I think this is not data driven, it's data conceptualized. My belief is that attaching your portfolio or increasing exposure to the positive correlation of tariffs will only generate outsized returns when tariffs are eased. Okay. So I really, really, really don't like that. I really don't like that about this. And I feel like the volatility that you're absorbing on a stock like this versus the returns are negative. I think it's a negative risk adjusted return. And so to sum all that up, I don't think that the valuation is low enough to compensate for these risks. If this company was trading below half of book value, I might consider differently, because then you would be taking much less risk. And if tariffs get rolled back, there's a de-escalation of the trade war, then you see a big jump. But is that more than you would see by investing in something less risky like the S&P 500? I'm not sure. I'm really not sure. So for those two reasons, I'm gonna have to say that this one is an avoid. It's an avoid. I definitely wouldn't short it. I don't like to short things. I wouldn't say it's a sell necessarily. I would say it's an avoid for those two reasons. that the valuation is not compelling enough to me on a very simple, less than hour run through. It's not compelling enough to me. And we're taking on the beta. So if your strategy is to take on the beta risk of tariffs, in other words, you are taking the belief that over the next year that the news that comes out about tariffs is overwhelmingly positive for your investments, then you probably should increase your exposure to this stock. However, that's the opposite approach of what I'm taking. I'm doing the inverse of that. So for those reasons, I'm going to have to say that it's an avoid. And that's even before we get into the technical analysis of it. I mean, it's trading at a stock price that is at the lowest level since the depths of the GFC. And in fact, if you see that, if you would have bought the stock there, you would have 10x to the high that was seen right before COVID. Now, the stock dropped 50% and it never recovered all the way to all time highs. We're at, I mean, it's down 60 something percent from the highs there. I mean, it's just an ugly looking chart. And I think it's safe to assume when we look at a chart like this, where we think like, oh man, the only way to go is up, and it's not. I mean, these things can go to zero, right? So it's very not only is it in a downtrend here, but we're retesting the long-term support level. All from a technical perspective, we're back. We've round tripped 17, 16 years of price action. Think about that. If you would have bought it here, you would have 10x'd, but you would have had to sell, because if you would have held till now, you'd be back to where you started. And that would be a huge opportunity cost on your portfolio. So I think, again, everything that I'm doing at the onset has nothing to do with the chart. And now looking at the chart, I think it maybe puts into more perspective why there appears to be some value here. And I agree that there is value. I think I like the moves that management has made. I really do. I think that the management team seems very competent because they have good brands. In fact, one thing that I've been texting with Rocco here over the last hour, and he talked about how they sold Supreme. So that was something that I missed, by the way, in the initial talk. I said that they had the Supreme brand here, and they don't. And so they've been offloading underperforming brands. They've been shoring up their balance sheet. They've been diversifying their manufacturing, but their work is more greatly cut out for them now with what's going on. I don't like the risk reward, but there is an opportunity. If I was convinced that the risk reward was good, I would definitely not enter the stock before earnings, because they're going to give their input on earnings. And one thing that I want to cover here is something that happened recently. Warby Parker. Warby Parker is like a kind of a similar company to this in certain respects. Also, consumer discretionary. They're the company that sells eyeglasses, and they sell glasses, right? So Warby Parker, they gave earnings, or they released a statement. They said their shares have fallen meaningfully over the last 30 days, down 41% this year. So pretty similar here to our company, down 50% in the last year to date, whereas Warby Parker down 41%. But you see what's going on here. They in a filing, they warned that if unable to mitigate the full impact of current and future import tariffs, costs on a significant portion of our products may increase further, which could reduce our margins or force us to raise profits, and our net financial results may be negatively affected. The impact could be as much as 14%. So they're saying that this is due to the substantial amount of raw material and components it sources from China. So they seemingly manufacture their own. They don't outsource as much of their manufacturing. based on inferring that from what is said. But if that company is going to disclose that, then what do you think the management team of VF is going to say? Okay. So you get the idea. I would just avoid anything that has this level of like on the nose tariff risk. I think that that's just I just don't like the risk reward, and I think the story needs to play out more. I think it is possible that they could continue to sell off. Um, they're going to come out, they're going to guide based on tariffs, or they're just going to avoid giving guidance. I think that that puts downward pressure on the price. It is possible that it could trade all the way down to the valuation I want to see on it, and the tariff picture could get a little bit better, and in which case that would be much more interesting. So for now, I'm going to say it's an avoid, and but definitely interesting. I think these types of companies, this one and Warby Parker here, it looks like this one's a little bit better performing. I think these types of companies are interesting short-term trades at a certain point, but what's the entry point? Well, I don't think we're close to the entry point there. I really don't. So I really hesitate to to highlight that. You do see that this shop here are calling a buy target on Warby Parker with 85% upside. I just maybe intrinsically it might be worth that, but I think that sentiment is more important than underlying business performance for these companies right now. So anyways, I'll quit rambling on. That's going to be the video today. Hopefully you found this interesting. Rocco, if you're out there watching, hopefully this adds to your analysis of taking a look at it. I certainly see why it's under the microscope right now, and I think that it is worth watching. You see, there's actually a lot of people following this ticker and Seeking Alpha. It is worth watching, and these types of names could make for a nice little trade on better outlook macroeconomically. But again, my analysis is shaded or jaded by my biases against consumer discretionary product companies. I really don't like them. So analysts out there that maybe are more well versed in consumer discretionary might give it a more fair shake, but that is not me. So anyways, hopefully this has been fun and educational, and I've got a lot of work to do. There's a lot going on in the markets, a lot to cover. So I'm going to, get off here, edit this video, and get on to the next one. All right. Thank you for watching, and I'll see you soon.